welcome. Thank you so much for attending week 4 and our final installation of BFSG's fall webinar series. My name is Erin Schneider and I'm an investment research analyst here at BFSG. Today we'll be discussing Investing 101. Honestly, it's a great session for those of you just getting started in your career or a really great refresher for those who want to reorganize their finances. And with that, I'm going to hand it over to our presenters today, Tina and Mike.
Great. Thanks, Erin. Well, hello, everyone, and thank you for joining us. My name is Tina Shackman, and I'm a senior retirement plan consultant with Benefit Financial Services Group. And my day-to-day responsibilities include working directly with retirement plan committees to help ensure the retirement plan is operating smoothly and that the investment options offered in the plan are prudently selected. And with me today is Mike Albee.
Thanks, Tina. Thanks for joining me, and thanks everyone else for joining me. We've got a good group here today, and we're looking to hopefully teach everyone some investing tips to help them achieve their goals and financial dreams. And that's what I do on my day-to-day. I'm a wealth manager and senior portfolio manager. I work with our wealth management clients on financial planning, on investing their portfolios. And so we're excited to be here today to pass along some tips that we've accumulated over the years.
Yep, and what we thought we'd do is start out with a poll just to see how you would all describe investing. So Erin's going to go ahead and launch that poll, and we'll see what kind of responses we get. Okay, well, it looks like most of you, over 80%, got the right answer. It is really using your current assets with the expectation of earning incomes, earning income or profit in the future. A few folks, thought it was like Vegas, more of a game of chance, and some actually responded that it was available only to wealthy people. So we'll dispel those myths as we go through this. So there are many reasons to start investing, and the first is the ability to grow your wealth through compound interest. Albert Einstein famously said that compound interest is the eighth wonder of the world. And compound interest is basically when your money earns money and those earnings earn money. So basically, it's earning interest upon interest. And this will allow your investments to grow faster. So one way to think about it is if you have $100 earning 5% interest, at the end of the year, you'll have $105. Now you'll have that $105 earning interest, and this will just keep repeating itself over the years to the point where that $100 could turn into over $400 over the period of 30 years if you've been able to consistently earn 5%. And all you had to do was sit and watch your money grow. So another reason that it's especially important in today's inflationary environment is preserving your purchasing power. And one way to think about that is if you had $100,000 today and it earns 3%, but inflation is running at 4%, then you would lose 1% of purchasing power on your money because that $100,000 is now only going to be buying $99,000 worth of goods because inflation and prices are higher. So this can be particularly important when you retire and you're living on a fixed budget because your income may not be able to cover increasing costs. Another area where there are many unknowns is trying to figure out how much you should save for the future, such as, how long are you going to live in retirement? And this has really been the biggest unknown. Researchers project that there will be 3.7 million centenarians on this planet by the year 2050. These are people that live to be 100 years or older. So it is going to become more common for people to have to plan for potentially 30 years or more of not getting a paycheck and relying on their savings to provide that income in their retirement years. And you've all probably seen the headlines that, or the statistic that says 60% of Americans don't have enough savings to cover an emergency expense. So when we are developing financial plans for our clients, emergency savings is one of the first items we check for or suggest just to make sure that they're prepared for when life brings the unexpected. And finally, there may be things that you want to achieve in your lifetime. Maybe it's traveling to all 50 states or visiting all the baseball arenas or living in a different country or buying a house on a lake. All of these things take money to accomplish. So that's why, when we think about investing, it certainly can make a big difference when you're accomplishing your life goals.
And Tina, I'm going to interject real quick before you
Yep.
move on.
You
Just
want me to
on
go
the
back to the other
emergency,
slide?
it's okay. Just on the emergency reserve, kind of good rule of thumb is 3 to 6 months
Mm.
of kind of expenses, the necessities of life. If you were to lose your job or something like that, be able to pay rent, mortgage, utilities, food, and having the kind of 3 to 6 months in cash and cash-like instruments, which we'll get into later.
Yeah, that's a good point. So we thought it would be a good opportunity to share an illustration that shows the difference between saving and investing. So Sam is a saver, and while he's been able to save a considerable amount of money over his lifetime, $800,000, he's given up a lot of compound interest and earnings on his savings over that 40 years. So basically be the same as putting your money under your mattress. But on the flip side, Katie's been saving and investing with an annual rate of return of 10%. And you can see that after 40 years, she will have more than $8 million more than Sam, just because she invested her money. Now, this is an extreme case, and it took a lot of discipline on Katie's part to stay invested and earn a 10% rate of return, but it's really meant to illustrate that investing over meaningful periods of time can have a major impact on increasing your wealth. So now that we've covered the importance of investing, let's take a look at the types of investments you can invest in. And the first and most obvious is cash. Today, your cash is earning much more than what it has previously. Right now, money markets, CDs, you're able to earn about 4 to 5%. Now, cash is typically used for those short-term accounts like checking and savings. And as Mike had mentioned, it can be used for emergency funds, or if you're saving for something and you just don't want to lose value. The next are bonds, and these are typically the next most conservative investment because they pay you interest, and if you hold a bond to maturity, you will get all of your investment back plus the interest that you've earned during that time. Bonds can range in maturities from treasury bills, which have maturities up to 1 year, short to intermediate bonds, which will have maturities of 1 to 10 years, and then longer dated bonds, which are usually 10 to 30 bonds, and these are typically treasury bonds. And the longer the maturity, the more risky the bond because there's a lot of time for the price to fluctuate when interest rates change. The relationship between bonds and interest rates is basically an inverse relationship. So when interest rates rise, the value of existing bonds will fall. And that's because there's a new bond on the street paying a higher interest rate, so existing bonds won't be worth as much. And when we think about, most individuals, when they do buy bonds, it's typically with maturities that are less than 10 years, just to reduce some of that price volatility. Mutual funds are a good way to diversify your risk among bonds and stocks. So these types of investments will pool all investor money together into a specific strategy, which could be comprised of all bonds or all stocks or a blend of both. Mutual funds are professionally managed, and they can have an actively managed strategy where the fund manager will buy and sell securities to meet the needs or the objectives of the investor, especially during changing market environments. Or they can be passively managed like an index fund, where the manager is just buying the stocks or bonds of the respective index that they're trying to track. The most common index fund strategy is tracking the S&P 500 index, which is intended to reflect the broad U.S. stock market, but there's other index strategies that track bonds or even international stocks. Exchange-traded funds, or we call them ETFs, because our industry loves acronyms. They are like mutual funds in that they pool investors' funds into a specific strategy, but unlike mutual funds, they trade like a stock, which means the value of the ETF will fluctuate throughout the day and you can buy and sell during trading hours. Whereas a mutual fund is assigned a value at the end of the trading day based on where all of the underlying investments ended up for that day. Now, ETFs are considered passive investment strategies similar to an index fund, and they tend to be cheaper than most actively managed mutual funds. And finally, as an investor, you can buy shares in publicly traded companies like Disney, Nike, or Microsoft. And this type of investment is considered the most risky because the price of a single stock can fluctuate wildly and dependent, upon how the company's profitability looks or the investor sentiment or overall market conditions. We've seen individual stocks rise and fall 5% on any given day. Now, this volatility can be smoothed out over time, but if you're someone that's not willing to see these types of losses in your portfolio, it may make sense to go with a more diversified strategy like a mutual fund.
Yeah, I would recommend. I mean, most investors probably would be investing in mutual funds and ETFs and staying away from individual stocks and bonds for those diversification purposes, and just hiring someone professionally to manage that. Or if they're doing it themselves, they're not picking and choosing individual stocks and bonds.
Yep. And so, while it's true that stocks have outperformed bonds over the long run, they do carry a higher degree of risk, as we just discussed. So, the price of a security fluctuates rapidly in a short time span. That's termed high volatility. And if you think about, technology stocks, we see large swings. They typically tend to make the business news. That's typically what we consider when we're talking about higher volatility. If the price of a security will fluctuate slowly over a longer period of time, then it's typically termed to be low volatility, and that's what we typically see with bonds. So it is important to note that there is no such thing as a free lunch when it comes to investing. If you want to get higher returns, you will need to take on more risk. And if you have a longer time horizon, these risks can smooth out over time. But if your investing time horizon is short, and that could be, 1 year, 2, 3 years, then you may not want to take on more risk. Unfortunately, we've seen savers unknowingly take on more risk in their portfolios because they tend to get overconfident during bull markets. When markets continue in that upward trajectory, and they don't sell or rebalance their portfolio to a level that's more appropriate. So they end up just taking on more risk in the portfolio, which is why the saying, what goes up must come down, is a pretty appropriate idiom for the stock market. And remember that investments are not guaranteed unless you're specifically buying a guaranteed investment like an annuity. So you will experience volatility, and there is risk of losing your principal or the original investment that you've made. Now, I guess, we've talked a lot about the risk. Let's focus on how investments actually make money. There are 3 major areas that investments can make money, and it's mostly dependent on the type of investments that you invest in. For example, if you're investing in a short-term investment like a savings account, a money market, CD, or treasury bills, then you're generating interest income because these vehicles provide you with a stated interest rate that they'll pay you when you invest in them. Now, if you own individual stocks, some of them may pay you a dividend through their earnings if it's a mature company like AT&T or Exxon or Johnson & Johnson, because they're able to earn excess profits and share that back with the shareholders. However, if the company is still trying to grow, so think of a startup company or maybe a technology company, they need to keep reinvesting into the company. So it's very unlikely that they'd be paying out dividends because they'd want to make sure that they're able to ensure the growth of that company in the future. And then capital gains and losses occur when you sell an investment and you realize an actual gain or loss. Now, in qualified accounts like a 401k or an IRA, these gains are deferred until you start taking distributions out of the accounts. But in a non-qualified account, like a savings account or a brokerage account, these gains or losses will be realized at the end of each tax year, and you'd end up having to pay taxes on those. So when we think about gains and losses, it's really more beneficial to hold investments for 1 year or longer because of the preferential tax treatment. since short-term gains, which would be investments held less than 1 year, are taxed at a higher rate. And something to also think about when we think about mutual funds, these dividends and earnings and gains do get passed down to the shareholders. So even if you're in a mutual fund and you're in a non-qualified account, you still can be earning income or experiencing gains within the underlying investment that get passed through to you as a shareholder. Anything to add there, Mike?
No, it just yeah, long term, it's better to be a long term investor. Just from I mean, the big reason is the taxes, like you mentioned. I mean, to hold it a year and a day, it makes a lot more sense tax wise. I think that's key to keep taxes low, and one of the big investing tips we'll hammer home later on as well.
So, and when we talk about investing, really the most important thing is not timing markets, but being invested in the markets. And if you invested in a portfolio that has more risk than you can tolerate, you may be tempted to sell that investment and move to cash. But as you can see, missing out on a few good days in the market can have a significant impact on your portfolio's performance. So this chart illustrates that if you invested $10,000 on January 1st of 2003 and stayed invested in the S&P 500 index for the next 20 years, you would have experienced a 9.8% annualized return. But if you had missed just 10 of the best days during that time, your return is almost cut in half. That's why it's so important to build a mix of investments that you're comfortable with and will stay invested during these periods of volatility.
I
And
think
one
one
thing,
other thing,
oh, go
sorry,
ahead.
Tina, one other thing on that too is just you hear all these talking heads all the time of selling, getting out, get back in. It's better to ignore the noise. There's again, know what your risk is, manage that risk, stay invested for the long term, and just kind of ignore all the noise out there because as we've seen, I mean, markets have historically gone up over long periods of time, and that's through wars and other geopolitical events and political regimes. Things change, and but that compounding nature and staying invested as treated as a friend.
Yeah, and that's a good segue because as we know, markets definitely fluctuate. And you can see in this chart, and there's a lot of numbers and colors here, but what it's representing is that no single asset class will really stay at the top year over year. Now, there are periods where certain asset classes may have sustained performance. So, for example, if you look at the period from 2010 to 2015, you'll see the real estate investment trust, which is a category that invests in all types of real estate. It was the top performing asset class 5 out of the 6 years. But if you recall, we had just come out of the Great Recession. And if that chart went further back, you'd see that this asset class was closer to the bottom of the chart. So it's very difficult to predict what types of investments will perform well in any given year. And if you do look in the middle of the chart, you'll see the white boxes. And those comprise a balanced portfolio that's made up of portions of each of the asset classes on the page. And while it's not hitting it out of the park every year, it's also not falling to the bottom. And historically, this type of strategy will provide a smoother ride for investors. So I'm going to turn it over to Mike, and he can talk about how to build a portfolio that's right for you.
So yeah, and we've talked a lot about risk, and I look at risk as not, I mean, you look at it as a potential to lose money, but it's more volatility. I mean, you stay invested over a longer period of time, your probability of making money goes up. And so a way to look at, I mean, potential risk and return is looking really at the downside. It's a good method to help determine what's the appropriate risk for you and your risk tolerance. So we look at these various portfolios to the far left, conservative, which typically has more bonds, to the far right, aggressive allocation typically has more investments in stocks, maybe some US stocks, international stocks, small and mid-sized companies. And so you look though at that far right portfolio, the aggressive allocation, and the worst year on record, going back to 1970, was down 36%. And so you have to be able to stomach these infrequent down years. Luckily, we don't have many of them, but we do have them. And you've got to be able to ride through that and stick to your investment plan, not try to time the market. So that's kind of a good way to start. Like, can I stomach a year where stocks, an aggressive mix of stocks and bonds, could be down 36%? If the answer is no, then you kind of back off and work down that kind of model food chain and go, okay, what's the right mix? What can I handle? Again, like Tina Lynch mentioned, there's no free lunch. To earn better returns, you have to take some risk, which typically, again, means a higher allocation to stocks. But just, I think that's a good way to look at it, is pick the appropriate risk profile and then allocate that way. The other thing I think that makes sense is you can bucket. I think we already had a question. I'll kind of pre-answer it, is just, what do I do if there's a home purchase? You can have different accounts for different goals. So like I mentioned, the emergency reserve, that should be in cash, CDs, treasury bills, something with no principal risk. But a short-term goal, kind of in the next 1 to 5 years, a car purchase, a home purchase, you can maybe go out to the spectrum a little bit, depending on the time frame of that goal, and start to buy some bonds. But longer term goals, retirement, other things, typically you have some stocks in there. So you can kind of take that bucketing approach as well, and create kind of different risk buckets. And just finally, these asset allocations, they don't exist in a vacuum. As you progress through retirement, your time horizon shortens, and your risk tolerance may decline, and your need for long-term growth may lessen. So you typically, what we see is most investors gradually go from being more aggressive as they're younger in the retirement accounts, and then it gradually kind of moves to more moderate to conservative as you get into and through retirement. So just kind of keep that in mind. Everything we're saying is kind of high levels, not specific for your goals and risk, but just kind of some strategies to throw out there. So now let's take a look at some of the ways you can save and invest. I would imagine most of us on this webinar are familiar with savings accounts and CDs. As I mentioned, these are great for emergency reserves. There's no principal risk. Luckily today, cash is no longer trash. You can actually earn 4 to 5% on high yield savings accounts, CDs, treasury bills, kind of maturing in the next year, are paying around 5.3%. And those also are state and local tax free on the interest earned from them. So we have options today for short-term savings and emergency reserves. Another account that you can open is a brokerage account. These are for after-tax investments, maybe for other goals like that car or home purchase, or if you've already maxed out all of your retirement accounts, another way to save. The money in this account gets taxed each and every year, any interest, dividends, or realized gains. And you get what's called a 1099 the following year, and you have to pay taxes on this account. But it's a great additional way to save for, again, those kind of medium-term goals. And finally, tax advantage accounts. This is, think your 401k with your employer, traditional IRA or Roth IRA, even health savings accounts and 529 plans. They're tax advantage, but savings for specific goals in the future. So these are a great way to build wealth because they compound free of taxes until there's withdrawals, depending on which type of tax advantage account. So, and most of us are very familiar with these types of accounts through our employer. All right, so since workplace savings programs are a great way to start investing, we'd like to see how many of you understand the other benefits of these types of programs. Yeah, all of the above. Everyone, I mean, these are pretty what I mean, I often take for granted in basic things, but retirement plans are a way to save for retirement. The name is in the title right there, and I mentioned reduced income taxes because you defer over the time, and then a lot of employers make matching contributions, and that's the one free lunch in investing is if your employer provides a match, take advantage of that. Tina, anything you want to add?
No, no. I think, the other part you're going to get into a little bit later is the ability to be investing continually, and how that can have a long-term positive impact on your overall savings. So,
Yeah, actually, that's the next slide. That was a
oh,
perfect segue into that. So, if you want to move it forward, we'll look at that power of compounding, like Einstein said, saving early and often and investing what you save are just some of the keys to successful retirement due to that power of long-term compounding. So let's look at an example. In this example, we assume a investor age 25, which is that blue line, makes annual contributions of $1,200 for 40 years. So their total contributions about 48,000. The yellow line is an age 35 investor making the same total contributions of 48,000, but they got started later at age 35 and made annual contributions of $1,600. And then finally, the green line, an age 45 investor making annual contributions of 2,400 for 20 years, making that same contribution total of 48,000. And you can just see, again, the nature of compounding. We're assuming it's 6% per year returns over time. But this shows you that power of the compounding and just the 25-year-old who started early and saved often had double the accumulated savings, even though they contributed that same amount, the 48,000. So it's just unfortunate that the sad reality today is that on average, Americans are saving well below the 10 to 15% consistent annual savings rate required to successfully fund retirement, and many start late. So just start today, whatever dollar amount, start today. It's just going to make your position so much better in the long run. Another thing, I mean, just markets can be scary. Going back to that first survey question, it's like Vegas. You're investing in companies with earnings. There are speculative investments, but markets move up and down on a daily basis. So one thing, I mean, you can look at is investing is all about taking a long-term perspective. And part of taking that long-term perspective is dollar cost averaging. And dollar cost averaging is just investing the same amount at regular intervals. In this example, we're looking at it's every 6 months. And depending on the level of the stock market, you may end up buying more shares for less or for more. But it lowers your market risk by averaging the prices out. So it's really a way to take the emotions out of investing. And for those investing in like your 401k or retirement plan, 403b, whatever that is, you're already doing this. Each pay period, your contribution comes out of your check and it's invested in the mix of mutual funds or whatever investments that you have automatically each and every month. You're dollar cost averaging and again, kind of taking the emotions out of investing.
Mike, one thing I'd add on this one is sometimes people might come into money or they've been saving and now they want to invest, but they're concerned that the market might be too high. So this is actually a good strategy to slowly enter the markets. That way you're not investing at, maybe a peak value or, when the markets are
Yeah, if those are
rallying.
concerns, exactly. If those are concerns of yours, it's a great way to just take, hey, every month or every 3 months, I'm gonna put a new amount in, invest it, no matter what's going on in the markets. It's just a way to slowly get invested over time if you're starting from scratch. The other thing really important is rebalancing. Regular rebalancing plan helps instill discipline in your investing process. And what we talk about when we say rebalancing, say you've got 60% stocks, 40% bonds, and because stocks are increasing at a faster rate than bonds, stocks go all the way up to 70% of your allocation because of that growth. Rebalancing is bringing it back down from 70 back down to 60, selling some stocks, buying bonds again. And what that's really forcing you to do is sell high and buy low. And it's also keeping risk in check because if in a rising equity market, by not rebalancing, it causes you to take on more risk than what was originally intended. So when we look in this example, comparing that 60-40 stock bond portfolio that's never rebalanced, which is the blue bar, to one that's rebalanced annually this is from 1970 to 2021, which is the purple bar. The never rebalanced portfolio takes on substantially higher risk, as seen on the left-hand side of that chart, the 12.2 versus 10.7. And it only barely has better performance. So again, we think rebalancing at least annually is a smart strategy to control risk and avoid poorly timed emotional decisions. Tina, anything you wanted to add there before I wrap up? And
Oops, just realized I accidentally hit something.
no worries.
Um, yeah, no. I was just thinking about we've seen this before where we've had sequence of returns where we've seen equity markets down, 2 years in a row. And that's been that can be a problem for those that are getting closer to retirement. I understand this is more of a investing 101. So probably not a lot of folks that are, nearing retirement, but that can be something that you really want to make sure of is when you're getting kind of closer to those times when you want to start pulling back and getting a little bit more conservative with your overall portfolio strategy,
Yeah.
that it gets done because
Yeah.
markets are unpredictable.
Yeah, and I would say just because you reach retirement doesn't mean you don't need stocks still in the
Yeah.
portfolio. Stocks are a hedge against inflation, long-term growth, fixed income. The name is in it, fixed. You get a fixed rate of return, and that those rates could decline over time depending where the interest rate environment is. So doesn't mean you move completely to 100% bonds at retirement because as Tina alluded to, we're going to have a good, hopefully 20, 30 years in front of us post retirement. So just to wrap up and recap what we've talked about today before we open it up for Q&A is the 4 keys to investment success. One is reach for the highest rate of return that's acceptable for you based on your time horizon and your risk tolerance. Seth Klarman, a well-known investor, has stated that the best investors do not target return. They focus first on risk and only then decide whether the projected return justifies taking each particular risk. So that's really important. We've hopefully hammered that today is just focus on risk and then invest from there. The other thing, it's start early. The sooner investing starts, the more benefit can be gained from that compounding interest, and keep a long-term perspective. Don't try to time markets and stay invested. Investing on a tax-deferred basis will help achieve your goals faster. So continue to contribute to those retirement accounts. Save on a regular basis. So the monthly or every paycheck investing to the retirement accounts, it's going to we talked about dollar cost averaging as a way to do this. And then rebalancing is really a risk control mechanism. Without rebalancing, the market dictates the risk level. And so appreciate everyone's time. Aaron or Tina, I'll kick it back to you guys.
Yeah.
Yeah. Guys, thank you so much, Mike and Tina, for that great presentation. We do have a lot of good questions in our Q&A, but before we go to that, I just want to again thank everyone for joining us today. If anyone needs to drop off early, we will be sending out the recording of this webinar so that you can reference it later. And as I mentioned, we would love to hear your feedback, including any topics for future webinars. So I'm going to go ahead and paste the link to that 1 to 2 minute survey in the chat box for everyone here, as well as the link to our BFSG University and YouTube channel, where we will post, again, recordings of this webinar, as well as other informational videos. So please go ahead and check those few links out. But for our first question, do high yield savings accounts typically outperform the inflation rate, or is there a more aggressive strategy one should be taking to offset that inflation?
Over a long period of time, the answer is no. Typically, cash and cash-like investments don't keep up with inflation. Today, you're getting between 4 to 5% on those, and inflation is at roughly 4%. So it's keeping up today, but I would say over a long period of time, the answer is no. So to offset inflation, typically you need to go out to the spectrum of risk, like Tina showed, was bonds typically earn a rate above inflation over a period of time, and stocks historically have done even better.
Mm-hmm. Even with the strong rates or strong returns that money markets and high yield savings are getting, if you look over a 10-year period, the annualized rate of return is about 1.5%. It's under 2%. So over the long run, to Mike's point, they would not be keeping pace with inflation, which we usually see at about 2%. I think it's a little bit higher. The long-term rate of inflation now is probably a little above 2%.
Yeah, I mean, estimates are for long-term inflation kind of over the next 10 years to be kind of in the 2.4, 2.6 range, depending on which measure you want to look at, which is higher than the Federal Reserve wants to get it down to 2. So that'll be interesting. But yeah, it's over a long period of time. Yeah, Tina's right. I mean, real returns on cash is about 1.5%. And just it's partly your outlook on inflation too, but it's not going to beat inflation in the long run.
Awesome. And similar to that, going along the lines of safe investing, can you describe I-bonds and TIPS and how they are for safe investors?
Yeah. You want me to take this, Tina?
Yeah, well, definitely the I-bonds. I could tackle TIPS, but
yeah. So they're both inflation bonds. They're linked to inflation and help guard against inflation to a certain extent. So they're both government issued. Treasury TIPS are Treasury inflation protected bonds. It's a Treasury bond that's linked to the consumer price index for inflation, and those bonds reset with their interest rate resets every 6 months, depending on what the core or the consumer price index is. I-bond is similar. It's adjusts as well. You can buy those directly through Treasury Direct, but I-bonds are limited. You can only buy 10,000 per year per individual through Treasury Direct, whereas a TIP or Treasury inflation protected security, there's no limits on how much you can buy.
mm-hmm.
Tina, anything you want to add?
Yeah, I think there's a kind of a little bit of a misconception that right now, because we're in a high inflationary environment, that TIPS would be a great investment. But because we saw such high increase in interest rates, they actually produced negative returns during the last quarter, because it's kind of an offsetting component. They're longer dated Treasury securities, and so as I'd mentioned before, the higher the maturity, the more price fluctuation they'll experience. So because they had that longer dated maturity and we had the interest rates going up, the value of the bonds actually went down, even though the coupon was being reset at these higher inflation rates. So
Yeah, and
Just
just
something to think about there with.
yeah, I think that's a great point. And the other thing is, I mean, the interest rates are variable on these. I mean, typically when you buy a bond, you get a fixed rate for, hey, I'm getting 4% for the next 5 years or whatever. These are variable. You get a fixed rate underneath, like on a tip. Today, that's I think around 1%, and then you get like an adjustment for inflation on top of that every 6 months. So that fixed rate's going to vary over time.
Yeah.
Awesome. Thanks, guys. We've talked a lot today about where to invest, what to invest, but a lot of people are wondering, how do they actually start investing? Aside from your 401k, how do individuals invest in brokerage accounts?
Yeah.
You want to take that one,
So
Mike?
yeah, sure. You can open up a brokerage account anywhere. Schwab, Fidelity, the two custodians we use, but you can, I mean, go to Vanguard, wherever. It's just a brokerage account's a taxable account that's typically in your name, or your spouse's in your name, or in a trust account, if you want to make sure it's titled properly. But you pay taxes each and every year. But those are, I mean, Schwab, Fidelity are the two largest custodians out there. So probably a good place to look at and start if that's of interest.
Mhm. And I would also add to what you were talking about earlier is just maybe setting up a routine investment to where you have a certain amount being deposited. It's kind of the easiest way. So a lot of times people feel they have to have a big chunk of money before they can actually start doing investing. So if you're able to maybe just set up some automatic um, savings program, a lot of these brokerage accounts will offer that too.
Yeah, and you can, I mean, most a brokerage account, typically there's no minimum to start. I mean, some places do, but you can, like I know for Schwab and Fidelity, I can speak for those, and you can go start with $100 and start investing.
And then with that, can we talk more about the taxation on brokerage accounts, the taxing of stock gains or paying taxes on dividends?
Yeah. So the brokerage accounts are taxed each and every year. You get a 1099. Interest from bonds, if you hold bonds in that account, uh, are taxed at ordinary income. So say you're in the 22% tax bracket, you're paying 22% on the interest for those. So one of the things we try to do when managing clients' money is the proper location of assets. We want to shelter bond interest from ordinary income at a higher rate and put those in tax deferred accounts. So typically we don't want to hold bonds unless they're tax-free bonds like municipal bonds from like the state of California in a brokerage account. Dividends, if they're qualified dividends, get taxed at a preferential tax rate of 15%, all the way down to 0%, depending on your tax bracket. And realized gains, if you sell something and you hold it longer than a year, that is taxed at, again, that 15% rate. Could be a little higher depending, again, on your tax bracket. So if you hold investments for the long term and dividends from stocks get preferential tax treatment, typically at 15%. Bonds taxed at ordinary income. Sorry, that was a long-winded answer.
No, it's got to go through all that because
Yeah.
there's a lot of variation depending on the type of income received.
Absolutely. We've gotten a lot of upvotes for this question. I know we spoke a little bit towards it earlier, but for those short-term big investments, such as, buying a car or buying a house, what is a strategy that we would suggest?
Yeah, it comes back down to time frame. I would say if it's in the near term, you don't want to, I mean, the last thing you want to do is be saving for a goal and 2 years from now, what you saved is less than what you were saving just because markets moved, unfortunately, downward in that period of time. So if the goals, I mean, kind of in the next 3 years, I would be saving in like a high yield savings account, treasury bills, kind of short term, very short term, risk-free investments. If the goal's 5, 10 years from now, you could start to get into more bonds and maybe stocks again, depending on your time horizon and just your risk tolerance. But the vast majority of kind of short-term goals should be in cash and kind of the likes. Tina, anything you want to add there?
No, I wouldn't disagree. And I think if, the other part of it is more of those intermediate goals, um, that you might even still have a component in cash, just because there's going to be a certain amount that you absolutely need to have, if you're saving for a house or a vehicle. So it really just kind of depends on the time horizon.
Yeah, I can give an example personally. I mean, I've got 529 college accounts for both my boys, who are 12 and 15. Um, and I mean, we've had those since they were born. They were very aggressive then because we knew we had 20 years before they went off to college, and we are going to have to be paying 18 to 20. But now, especially for our 15-year-old, he's getting closer to, it's weird, time flies, but he's going to be going to college soon. And so we start to transition and move that portfolio to be more conservative. Like you said, Tina, we've got a percentage of that now in short-term bonds and like a money market account, just because he is going to start drawing on that soon. The entire account's not in that, but we know we're getting closer to that goal.
Awesome. And then going towards that as well, I know we spoke slightly about rebalancing, but how does one decide when to rebalance? Should it be annually? Should it be more often? Any insight on that?
We mentioned annually at a minimum, twice a year you can do, depending on kind of your risk tolerance. If you allow for a little bigger drift, or just based on market activity. If you have a big run up in a very short period of time, maybe it makes sense. But typically, no more than twice a year. You rebalance too frequently, you don't let things run up. You're constantly trimming gains too fast. And so I would say once to twice a year.
Yeah. Models that we manage in retirement plans, usually it's semi-annually. And something to think about when you are in either a retirement plan or even a brokerage is that a lot of them will allow you to do this automatically. So you don't have to try and figure out, how much to sell here and there, that there's usually automatic features that allow you to establish rebalancing.
Yeah, that's a great tool to use on within plans.
Great. And going more into our investment vehicles, can you describe more on how bonds work, in the fixed income sector?
Yeah. Tina, I think we have a slide in the appendix we
Yeah.
can kind of jump to
Yeah.
on bonds, if you want to maybe cover that.
I gotta find it. We have a
One more, I
lot.
think.
Here we
There we go.
go.
Yeah.
Yeah. So basically, when you think about a bond, you're lending the company money. They, companies need to either sell equity where they're giving, ownership of the company away to stockholders, or they can sell debt and basically take a loan out. So when they do that, they need to provide what's called a coupon or an interest rate, because they're lending out they're you're lending them money, so you as an investor would expect to get some sort of earnings from that. They can range from a company issuing debt to the government issuing debt, which when we talk about treasuries or T-bills, that's the government. So when that happens, they are contracted to pay And usually it's semi-annually. Sometimes it can be annually, but they're contracted to pay you the interest on the loan that you're providing them. So that's kind of the way it typically works, where it's a fixed amount that you're giving them, and usually it's within, I believe the increments are $1,000 to buy a bond. So you'll give them the money, they'll give you this interest. There's a set term for how long that loan will be. And then at the end of that term, you'll get all of your principal back, plus you've earned all of that interest in the meantime.
Yeah, and there's all types of different bonds. So think, I mean, like if I lend money to the US government, they're taking that and building roads or whatever they're doing with the funds. The US government is the treasuries are the safest investment in the world. The US government's not going to default on our debt. They might print more money, which we have another issue with inflation, but there's no default risk. So, if I buy a treasury and a 5-year treasury, I'm going to hold it for 5 years and there's no risk of it uh, defaulting. I know I'm going to get that interest rate back. Then you can go buy like a corporate bond issued by, for example, Apple. Apple goes, hey, I want to build a factory. We need to raise money to build that factory. They raise that money from investors. They go, I'm going to pay you 6% over the next 7 years. As long as Apple doesn't go out of business, then you get that money back. And typically there's a little more risk because there's default risk there. And then it continues to go down the spectrum. You can go into junk bonds or high yield bonds. And I don't want to get too into the weeds, but their rates of bonds vary from a couple percent for the most conservative to the highest risk up to 10, 11% today.
Yeah, no, that you bring up a good point about the quality of the bond. Obviously, the government considered AAA rated or the highest quality you can get versus going all the way down to companies that might be on the edge of default. Those types of companies are going to pay a lot higher interest because they know there's a lot higher risk in lending them money. So that's hence the term high yield bonds or junk bonds.
Yeah, they renamed them high yield because the marketing whizzes on Wall Street didn't like the term
No,
junk
they did
bonds, trying
not.
to get them out. So,
And in terms of losses as well, so we've seen bonds that are struggling slightly in the short term, but even say for an account where your stocks are down 50%, is there really a good time to kind of cut your losses and run here, or should we ride it out? What's your advice there?
um, yeah, I think you again stick to your long-term game plan if you've got a mix of stocks and bonds. Just because you've gone through a period of a few tough years here with bonds doesn't mean you move out, and that's because bonds just 18, 24 months ago were yielding 2%. Um, and now as interest rates have gone up, as interest rates go up, the price of bonds go down. Those bonds have been negative for the past couple of years, and bonds were down 13% last year. That index, which is the worst, you have to go back like to the early 70s to see something similar. So it's but with the price declines now, bond yields are for high quality bonds in the range of 5 to 6%. So returns look much more attractive. So it all kind of, if you're invested for the long term, it kind of evens out. There's going to be years where losses happen, but now bonds are very attractive, and we're probably set up here for the next number of years to have pretty decent gains in them just because the yields are high. Tina, anything you want to add to that?
No, it's kind of an interesting because you think about equities where they've reached the top and or they're highly priced. That's how we think of bonds right now, that they're really at the top. So certainly an opportunity to invest in bonds and potentially get more capital or total return because you're going to be able to experience an increase in the price of the bonds as we start seeing interest rates fall.
Yeah. And
eventually.
most of the returns from bonds comes from starting yield. So if the starting yield today is say 5.5%, mathematically, as long as that bond doesn't default, say you buy a 5-year bond yielding 5.5%, you know what you're getting over the next 5 years. Um, so the biggest thing is inflation, and if that ran away to above that level that you fixed, inflation really is the biggest enemy of bonds.
Great. Switching gears, can you describe what a target date fund is, how that structure works, and who would best fit by using a target date?
Yes, we do have that. And this is a great question because a lot of retirement plans have target date funds. And really, the way that these operate is they are based on developing an allocation for when you plan to retire. So if you have a target date, which means if you have a targeted retirement date of 2065, that's going to be 40 years out. Then you're going to have a long time horizon. And what that's going to mean is that allocation is going to be pretty aggressive. It's probably going to be 90 to 95% in equities and maybe 5 or 10% in cash and fixed income. And what's going to happen is you can put all of your money in that target date fund based on when you plan on retiring. And then as you get closer and closer, so as time moves on, you get closer and closer to that retirement date, what's going to happen is that equity is going to start rolling down or gliding down, and it's going to get what we consider or what we call de-risking. So less and less exposure to equities, more exposure to more stable type of investments like bonds and cash. And then when you get to retirement, you will have a certain allocation based on that type of strategy. But as you can see in this chart, what happens, and Mike kind of alluded to this earlier, is just because you retire doesn't mean you should never own equities. You could have 20, 30 years in retirement. And so it's going to continue to give you that type of exposure just at lower levels. So the nice thing about target date funds is that they kind of are a set it and forget it type of strategy. You can put it in that year that you plan on retiring and leave it alone, and your allocation is going to get more conservative, and it's also going to rebalance. So you're never going to find yourself hopefully in a position where, even if we have bull markets, you won't find yourself in a position where you've taken on more risk than what that particular target date would deserve at that time.
Yeah,
So
and
it's kind of, go ahead.
I was just gonna you touched on it, but just want to make sure people caught is when you choose a target date fund, whatever that year you plan to retire, that should be 100% of your portfolio. You shouldn't have mutual fund XYZ over here and another target date fund because then you're messing up the allocation. These mutual fund companies get together their teams and figure out kind of the right mix of stocks and bonds in this glide path over time. If you've got all these other investments in the account along with the target date fund, you're kind of messing up that allocation and risk, and maybe taking on more risk or less risk than you need to for your specific scenario.
And because we are kind of in a a lot of folks on the phone might be early investors. When you do join your employer's retirement plan, if you don't make any selection, a lot of plans will have target date funds as what's considered a default fund, which means if you don't make any decision, you're just automatically going to be put into a target date fund based on your age. So you could automatically be in that type of fund, and it is going to be your entire account that would be allocated. To Mike's point, it wouldn't be spread out amongst all the other investments. It would just go into that one particular fund. And that's done because as the plan sponsor, as the employer of that plan, they want to make sure that you're in an allocation that's appropriate for you based on your particular time horizon to retirement. And target date funds are the perfect vehicle for that.
Great, Tina. Thanks for going over that. We've had a few questions too now about the backdoor Roth IRA method. Can you kind of go over what that is and how to avoid any negative tax implications?
Yeah, so um, Tina, maybe you can go to the limits. Good thing you put that in. Um,
Let's go here.
yeah, so actually go back one more to the
Oh,
IRA limits. So if you're in a 401k plan or some type of retirement plan, if one spouse is what's considered an active participant, if say if you're married filing jointly, that's that first line item there under the traditional IRA deduction phase outs. So one spouse is in a 401k plan through their employer, the other spouse is not. The IRS puts limits on how much if your income is above thresholds, then you can't contribute more to like a traditional IRA. And then if you're married filing jointly, both taxpayers are active participants. Or if you're single, you can see, and this is on our website too, these limits. So if you're above these thresholds from an income standpoint, you can't contribute to a traditional IRA and have it be tax deductible. You can still contribute to an IRA. It's considered a non-deductible contribution. Then what a strategy is you can to get around these limits is contribute to that IRA and then immediately convert it to a Roth, and then it's going to grow tax-free after that. So a backdoor Roth is a way to get around these phase outs. There's some rules that get complex with pro rata if you've got other IRAs, and so they are complex. I recommend if anyone's considering this, they talk to a tax professional, your advisor. But there are ways to get around these limits, and that's what a backdoor Roth is. Erin, hopefully that answered the question.
I think so.
You can also do this in retirement plans, but your retirement plan has to offer after-tax contributions. And then you can take those after-tax contributions and automatically convert them to Roth, but that provision has to be available
Yeah.
in the plan.
But anyone who has, I mean, specific questions on that, feel free to reach out to us, financialplanning@bfsg.com, and we'll get more into the weeds.
Absolutely. And kind of going off of that, is it worth hiring a financial advisor? How often should you meet with one? What's your thoughts on that?
Yeah, I mean, I'm going to say yes because that's my job. I mean, I look at us as a financial coach. We're constantly meeting with our clients throughout the year. When life changes, we pivot and we kind of create a roadmap to get to their short-term goals, intermediate term, and long-term goals. And life happens, and you're going to get a flat tire and veer off the road, and we bring you back on. So it's good to develop that financial plan. If there's a need, manage your investments. We do tax planning. We're super busy right now doing tax planning, trying to see what levers can we pull for our clients before 2023 ends. Because once 2023 ends, you're locked in. What you owe in taxes is owed. So is there anything we can be doing from harvesting losses in portfolios, charitable gifting, whatever that is? We're looking at those. So we're frequently meeting with clients, but I would say most people should probably be meeting with their advisor at least a couple times a year. Tina, anything you want to add there?
No, I think that makes sense. I wouldn't add anything there.
Okay. I know that's in my wheelhouse. So.
Yeah.
And I dropped our email in the chat box for everyone to see. If you have any questions, want to continue the conversation, feel free to reach out to that financialplanning@bfsg.com. But moving along, can we talk more about the FDIC, the Federal Deposit Insurance Corporation? For those, again, we love our acronyms. What is it? And yeah, just go on to a little depth about that.
Yeah. Tina, you want to cover a little bit of that and then I'll jump in?
Yeah, well, strangely enough, the FDIC is making headlines and not in a good way. Right now, I think the head of the FDIC is being investigated for kind of a toxic work environment. But that doesn't have anything to do with necessarily what the agency is designed to do. So this is basically an insurance program that if something were to happen to the bank that you are in, that you have your savings in, the federal government will step in and cover any losses that may be incurred with your account. So with the FDIC, the way that's structured right now is for every individual, you are insured up to $250,000 of your deposits. For married couple, it's 500,000. And my understanding, and Mike, correct me if I'm wrong there, but it's also based on different types of registrations. So if you have a trust account, an individual account, a joint account, I think there's ways to expand on the coverage.
Yeah, absolutely. It's per ownership category. So like you
Hmm.
just said, yeah, you can increase coverage through creative ways if you've got a balance over 250 or over 500, or different banks as well. It's per insured bank as well. Um, so
And the if you're investing in a brokerage account, so if you're opening up an account with Fidelity or Schwab, there's SIPC, which is a Security Insurance Protection. I forget what the C is.
corporation,
Corporation.
yeah,
And that's a little higher. What are the limits on SIPC? I think it's closer to 1 million.
I think it's 500,000. But a lot of like uh, Schwab and Fidelity have additional coverage. Like Schwab has additional coverage through like Lloyd's of London. So it's more though. I think if Schwab were to fail, um, that's when that insurance kicks in. It's not because of a loss of investments or something on your
Right.
part. It's if the brokerage firm were to actually fail, it's going to cover that. And in that case, I mean, those deposits are very valuable. Some other companies are probably going to swoop in and take those. So, and same with FDIC, as we saw. I mean, it's there where it's covered. The banks pay into that program, and the that money is there. We're not worried about the FDIC money not being there. They just increase their fees if their balance gets low. They increase their fees to the other banks. So JP Morgan, Wells Fargo pay more into it because they're larger banks. But going back to earlier this year, we saw some bank failures, regional banks, and FDIC uh, kicked in for some of them, but other ones just got gobbled up by competitors and all those depositors. The Silicon Valley Bank, for example, closed down for one day. JP Morgan, or is it JP Morgan? It was JP Morgan blanking, bought them. Next day, their bank was back open and serving depositors. So we feel pretty confident in the system, and but you want to stay under those FDIC limits. But it does not protect you from uh, your own losses and investments. It's there for failure of either the bank for FDIC or the brokerage firm for SIPC.
Great. Thanks, Mike.
Yeah.
Now, can you carry forward losses on brokerage investments?
You can, and so if you've got, unfortunately, you've got losses in your portfolio in a brokerage account, not a tax deferred account. Um, so you can harvest those losses, offset realized gains, and then if you have additional losses that you harvested and sold, you can carry those forward indefinitely. You can also offset up to 3,000 of ordinary income. So it's a great way to turn some lemons you have into lemonade and help you on taxes.
Perfect. And now, what are the fees surrounding a brokerage account, and how does one manage those fees? Are they taken out of your account? What's the situation there?
Yeah, I mean, typically, if you've got an advisor, there's management fees. Either say working with us, or you've worked with someone else, or a Fidelity retail rep. There are fees; those are taken directly out of the account. Those fees vary, but typically they're on average around 1% or less, and it's based on assets under management. Um, uh, then there's some miscellaneous fees on the underlying investments. And so, depending if you're using like mutual funds or ETFs, those accounts have fees. Those fees are just taken directly out of the fund. So the performance, it's not like you see a line item of fees. And then if you do any type of like wires or anything out of the account, um, cancellation of checks, there may be some fees from the brokerage company like Schwab or Fidelity. So there are various fees. It's something to be aware of. And the one thing I don't think we touched on, taxes, keep taxes low, be efficient with taxes, long-term investing, what you're investing in the proper location. But the other big thing is keeping fees low. Know what you're investing in. ETFs and mutual funds, just because it's an ETF doesn't mean it's cheaper than a mutual fund. We've seen plenty of ETFs that are higher expenses than mutual funds, but know what you're owning. And you can find that in the prospectus or on websites like Morningstar or Schwab, Fidelity offer those too. So
Great. And going one step further, so you do decide to hire a financial manager. What's a normal fee for that? And do you need to have a minimum amount to invest with a financial manager?
I said the average fees typically you see 1%. We have different solutions that fees vary, kind of starting going from 1% down to 0.5%. And so that's, I would say, typical is kind of that 1% fee. I've seen higher, at 1.5%, 2%. So be aware of that. Minimums it varies too. It just depends on the advisor. If they set minimums, some people have very high minimums. We have solutions where it's a $5,000 minimum, upwards to 250 to 500,000 minimum. So it just kind of varies. Everyone's going to be unique in how they handle that.
Great. Now, again, this was Investing 101. So we're thinking a lot of our participants here are just getting started in their career. What would you suggest outside of the 401k they should do investing? Should they be maxing out their 401k and be contributing elsewhere? What do you see a normal split to be?
Yeah, I hate this answer because it's going to be it depends. It's really unique to your own circumstances. If you've got a bunch of student debt or other debt, and what are you paying on that? But you should be contributing something to your retirement account, and if you can do it, the goal is to try to max it out. But a good rule of thumb is you should be saving about 10 to 15% per year. And if most of that, especially if it's a long-term goal for retirement, should be in the tax-deferred accounts, because those assets are compounding tax-free.
Yeah, I would also say kind of the minimum within a retirement plan is to make sure that you're saving at least up to the employer's matching contribution.
Yeah.
You never really want to leave money on the table. So if they're matching up to 6% of your compensation, then you want to try and defer or contribute at least 6% so that you can get the full match.
Yeah, like I said earlier, that's the one free lunch in investing. If your employer's
Mm.
matching, that's free money. Don't leave it on the table. So, and if you're if you're a great saver and you're maxing out retirement and contributing the max that you can to that, then and you have excess savings, start to save to brokerage account.
Right.
That's great. Now, for those that are more middle-aged, say 40 to 50, and they're just starting out investing, so want to retire in about 20 years, what would a good strategy be for them?
Yeah, going back to again, it's going to be it depends and specific to what cash needs are going to be in retirement. How much are you making, and how much can you be saving? Uh, Tina, do you mind real quick going back to that line chart, the different age groups?
Yep.
Yeah. So this kind of again, it showed someone who's age 45 and starting late. Um, and uh, you're just if you're a little later in the game, you're gotta start saving more. It's gonna be a little harder to catch up. It's not too late. Start saving now, but you gotta save a little more. But it's gonna again, if this person wants to chat offline, we can be a little more specific.
Feel free to reach out. Now, how would you respond to someone that says, how do we know if this growth can continue? You know, we've seen some pullback in the past few years, but we had a really long period of growth. So how do we know that that's just going to continue?
I don't know, but I can point to long-term returns, what's happened over long periods of time. I going back to, don't quote me on these, but it's a study's been done looking all the way back to 1871, like pretty much the start of the Federal Reserve and monetary policy. Stocks have outperformed bonds and cash in any given year on average around 60 to 65% of the time. That's any given year. You expand that to 10 years, 15 years, 20 years, 30 years, those percentages, I mean, stocks outperform bonds and cash 99% of the time over a 20-year period of time. And that's from 1871 to like 2022 or 2021. A very wide range of lots of events that have happened during that period of time, world wars and other things, and markets have climbed that wall of worry over time. So I think it's difficult to say this time is going to be different, why that won't continue. You're going to have up and down years. You'll have periods. I mean, we've gone through a decade, like during the dot-com in the early 2000s when the U.S. stock kind of tech bubble burst. The S&P 500, the broad U.S. index, kind of went sideways for after that exploded for the next decade. So it's not saying that you can't have years or a stretch where returns aren't great, but we eventually climb that wall of worry, and it all comes back to earnings and valuations, and companies continue to grow earnings and make more widgets or sell more services or whatever it is, and populations growing. And Apple, for example, sells more iPhones in China than here, and that growing population. So they continue to grow earnings over time, and the stock goes up. Not to say there won't have a earnings recession or earnings will drop in any given year and the stock may decline, but I don't see why it won't continue. It's just you got to be invested for the long term.
Yeah, and I think that's, going back to just having a diversified approach, making sure that you have access to different parts of the market. The way we look at it is we look at it in very different segments. If you look over the last 3 years, you might be saying, what was the kind of the best performing segment, from the beginning of the pandemic? And it's actually small cap value stocks. Think about, the cheapest part of the market, smallest part of the market. That was the most risky, and that was an area that had been rewarded, during the pandemic. Now we're kind of moving into, large cap growth again because we have 7 stocks that are really, really benefiting from artificial intelligence and new technology. And so it really just really is dependent, but we can't predict it. We just know that over the long run, to Mike's point, they will provide return, but you just want to make sure that you're diversified.
Yeah. And if they don't, go buy guns and gold.
Just kidding.
Just kidding. That was a disclaimer. Just kidding.
Now going back to rebalancing a little bit, in a 401k plan, will the brokerage rebalance for you?
It could. And most 401k plans, the administrator or the record keeper, so think of Fidelity as a big record keeper, they will have a feature in the plan that allows you to automatically rebalance. You have to look for it, but usually they are under the investment section, so you can set up a portfolio and then click a box that'll say, rebalance for me. But I would say the majority of 401k administrators have that feature available.
Yeah, great. Just gotta snoop around on your website there. And this is our last question, and we might have touched on it a little bit already, but how do you go about changing your investment model? Do you have to reach out to your brokerage where your account's being held?
Yeah, I'll try to answer this the best of my ability. It kind of, again, it depends. If you're managing your investments on your own in like a brokerage account, typically there's no models. You're doing it on your own. You're selecting and picking stuff. If you hire a professional, then they will typically manage that for you, where they're going to be rebalancing the account, picking the investments, working with you to understand your risk tolerance and your time horizons, and making sure they're knowing what your goals are, so they revise that investment model and allocations. But they're typically, you're hiring them and paying them to do that. In a 401k, there are sometimes model portfolios, and that's typically the investment consultant helping build those models.
Well, great, guys. That was our last question of the day, and we are just about at 11:30, so great timing. Thank you so much again to our presenters, Tina and Mike. That was a wonderful presentation. And thank you all for coming and your wonderful questions as well. You guys have a great rest of your day.
Yes. Thank you, everyone. We appreciate you joining us.